Welcome back to B Grade Economics. This is Nate, your class leader. I'm going to do a presentation that's going to be a long one. There are 30 slides in this brief, so I'm going to be frank with you. It's going to be long, but you may want to stick around because this is a major hypothesis that I've been working on the total role of Bitcoin as a macro asset and its transition into full adoption. Now, this has been hitting me more and more recently, and I've finally worked out kind of where my core thesis is with this investment as far as how it will go into adoption. And when we say into adoption, what I mean is we're going to get away from highly volatile spikes up and down, and we're going to get a more progressive acceptance of this as something to stick around and invest in, or to continue to use as base money or a form of currency. And so what I intend to prove is that Bitcoin is acting as a reserve asset in the nascent crypto space, but is acting as a macro risk-on asset and may prove that it is actually capable of functioning as a risk-off asset during a financial crisis. Now, this has been one of the biggest arguments against Bitcoin in terms of it has never seen a real bear market. It has only performed in a bull market and during a tech speculative era. It came out onto the market around 2010, and 2011 was when the stock market began recovering. So even though it was invented and came out of the global financial crisis, we obviously haven't had a chance to test what it does in a real financial crisis. So we're going to begin. I hope that was enough up front to give you an idea of where we're going and see if you want to stick around. This may take a minute. Okay, so here is Bitcoin and the US 10-year yield curve, or the 10-year yield, bond yield. And what I want to say about this bond yield is that it is hyper correlative to Bitcoin's price action. What I mean is that when people are selling bonds and the price of the bond reduces and the yield goes up, Bitcoin's price is going up. And when people are buying bonds as an attempt to preserve their purchasing power for later, Bitcoin's price begins to decline. This implies that it's acting as a risk-on asset. However, if you're selling bonds and buying Bitcoin, you might be speculating. And maybe it's not direct, maybe it's just the cash flow and the liquidity increase. But if you're selling bonds to buy Bitcoin, or you're a Bitcoiner who wants something to act as a reserve asset, you're treating it like it is another form of security. It is a stable form of return. Now, one might say that this is taking a risky move, but I intended to prove that this is actually people attempting to preserve their purchasing power. Yes, it's going to come with gains. Yes, it's going to come with speculators, but I'm going to show that there's a core basis of people who are using this as a wealth preservation asset. And so it is beginning to have a small market replacing bonds. Bonds are a multi-trillion, massive market. The United States bonds are the largest security asset in the world, and Bitcoin is a $1 trillion asset. So it's really small and easily influenced by a small amount of liquidity added to its largely 76% illiquid supply. So I'm going to show, continuing here, a chart from Game of Trades. Peter from Game of Trades did a video showing that Bitcoin has risen when the 10-year Treasury note is selling off. In other words, people are selling their bonds and they're moving into risk-on moves. And when the bonds finally reach a point where people are willing to purchase them again, Bitcoin moves back down. And so we've seen this cycle of Bitcoin adoption also interplay with the bond market's growth and tightening. Recently, we've hit a major low, sub 1% yield from the bond market due to the global health crisis. And what I want to point out is that from this low level, there's really nowhere to go but up. Because even if you discount inflation, it's hard to reason that you should hold a bond that's yielding less than 1%. It's Other than a savings account, almost anything else out there will yield more than 1% in almost any market environment if you're savvy enough. And so it's more likely that people are piling into these in order to avoid major catastrophe and risk. However, we've seen that inflation has continued to rise, so we're probably going to see the bond yield begin to rise as well. Now, to go over some Bitcoin cycle metrics and just talk about how they have evolved and changed so that we set a precedence for how we're going to shift, we need to understand what has happened. We have 4 cycles in Bitcoin total right now. The first cycle was the initial price discovery. It was the idea of, hey, here's Bitcoin. Here is a product in which you can apply a price to and use it as a form of transactable means. In 2011, a man purchased a pizza using Bitcoin via intermediary transfer to someone else who also paid for the pizza. Now, this proved that there is value to the token, and it allowed people to figure out what to do with it. They could apply a price. There was a speculative mania, and the bubble came back down. You know, it just rushed up, went through a couple of monotonous jumps, and then it made it back down. Really small movement, really small market cap. It was really just a first move in introducing this technology, and early adopters got on board very quickly. The next cycle truly was early adopter cycle phase, and they didn't know what to do with it. And it kind of mimics major adoptions of currencies like gold, where it is a nascent currency. There weren't any real competitors. It wasn't until around 2014, 2015 when people started to mess with block sizes and try to change out and split and fork Bitcoin to have competition, so to speak. And since that wasn't really around, this was the market adopting it following a halving. And the halving was a cut in 2012 of the block rewards to miners. And so the supply began to be cut. And this set the precedence that after the halving, the price should increase because the supply has been shocked down lower because the miners begin to hold their coins in order to speculate that the value will go up. So the masses begin to purchase the coin, removing supply, which causes the price to go up. They then sell into volume as more traders come in, and the price went down. Now, 2017 had a much more monotonic rise. From 2015 to 2016 low area, it basically just went almost straight up with only small corrections, 30, 40% along the way. I say small in comparison to the space and how small the market cap was. And it made it to $20,000 per coin. Now, when it did this, there were a couple other things going on. From 2015, as I said before, 2015 was approximately when most of the altcoins started to show up. The idea that, hey, we could do ICOs, initial coin offerings. And what occurred here was the way to buy these ICOs was to use Bitcoin as a currency, as a means of transaction. So it incentivized you to buy Bitcoin because you had to use it to swap. And then it became a reserve asset, so it was much more stable than all these other speculative new coins. So Bitcoin held up the most on the way through this. At this current phase, we have altcoins that have grown very drastically. And throughout the Bitcoin previous bear market, we had, which I don't know if you really call it too much of a bear market, it had a downturn and a little bit of a sideways chop, but ultimately it was a very vibrant market. But overall, people thought it was going away, that it was going to die, or these altcoins were going to replace it. But what we're seeing is that it's actually acting as a reserve asset anyways, even though they don't have to swap for Bitcoin. I'm going to show how that's working even now, as it acts as a more risk-off purchase in the crypto space. So to throw this in, from 2011, 2012, when around Bitcoin getting its first pricing, and this chart shows you Bitcoin versus the NASDAQ, and it's the NASDAQ priced in gold, and Bitcoin versus gold. And the argument is that really Bitcoin is just a speculative trade, and so it's just following the NASDAQ. Well, I'm going to make an adoption cycle argument here. Here's down in the bottom right corner is Bitcoin priced in the NASDAQ itself. It doesn't matter what you, as Benjamin Cohen had pointed out, it doesn't matter what you price Bitcoin in. no asset has performed it better than it other than certain altcoins. So through that 10-year period, there's nothing that has performed better than it throughout that whole cycle, which means that basically anything you price from the legacy markets will be outperformed by Bitcoin and look approximately the same. So I really don't take that argument very seriously, because the claim that the NASDAQ is really just a speculative risk-on trade, and therefore so is Bitcoin because they've both gone up. If you do it versus gold, it really just paints the picture that gold has performed poorly against all other assets at the time, which it's just, I feel that it's a weak argument. There's plenty of great arguments for gold. I don't think that it has anything to do with Bitcoin or the NASDAQ at this point in time. Now, to strengthen this discussion, here is the 10-year Treasury note yield from this past 2 years. And we saw it crash, spike up, and then crash again. And we see that the NASDAQ became inversely correlated to bond yields, right? Now remember, Bitcoin is correlated to bond yields. So if the NASDAQ is speculative risk on, why is Bitcoin operating inversely to the NASDAQ? Because the NASDAQ is inverse to the bond market. We are seeing an ellipse begin to close between the curve of the NASDAQ and the curve of the bond yield. Now, if the NASDAQ has a melt up, that'll disrupt this phase. However, if the bond yield begins to spike, it will cause a risk off move and money to flow out of the NASDAQ as people attempt to buy more bonds in order to protect themselves. So either the NASDAQ melts up and crash, or this ellipse begins to close further and further. And so the returns expected forward on the NASDAQ are going to begin to shrink. Now, this is just a projection of a line. It's not necessarily a guarantee that that is how it plays out, but I'm again going to continue to talk about this highly overpriced asset acting as risk on, and Bitcoin not acting as risk on by comparison. People are purchasing Bitcoin as a risk off move, and I'm going to show you it's both in crypto and eventually into the macro space. So here we have Bitcoin versus Ethereum. This is Bitcoin versus the purple line, Bitcoin, or Ethereum priced in Bitcoin, right? So this is it, the purple line is Ethereum outperforming Bitcoin or underperforming Bitcoin. And we see that when Bitcoin is spiking up, Ethereum is not in Bitcoin's price, meaning that Bitcoin is the trade to take. When Bitcoin goes down, it goes risk on to Ethereum. Now, Ethereum does come down with Bitcoin as the whole space kind of gets shaken out, because again, Bitcoin acts as sort of a reserve asset to the space. But when people's faith becomes shaken or they become scared, they pull out of the entire space. It's not the real economy yet. So it's not tied directly into the real economy. So when people pull their money out of the space, it's not as though they've lost the entire economy. It's just gone into other assets outside of cryptocurrencies. But what we see is that this risk on move with Ethereum continues to play out in an inverse relationship to Bitcoin. And if I do the same thing with the altcoin market cap, we will see the same thing play out, that Bitcoin's dominance drops as the risk on trade increases. People are going further out into the risk curve, even in the crypto space, from Bitcoin to Ethereum and on their way down by market cap. For an additional kicker here, we can see that right around the time that Bitcoin was peaking out in earlier this year, from March to April, as it started to taper back down, the NASDAQ and Ethereum to Bitcoin began to play in a correlative manner. You're seeing the risk on trade start to play out here. Now, when Bitcoin crashed and the NASDAQ crashed, Ethereum's price held up against Bitcoin for a period of time, and so you could see a divergence there. But after that, we start to see that they're highly correlative, implying that Bitcoin is a reserve asset and is a risk-off move in correlation to the bond market. So in the crypto space, Bitcoin is acting as a reserve asset. On the macro end of that, if the crypto space fails, historically, Bitcoin falls around at a max of 80%, while altcoins fall larger than Bitcoin does. They'll fall 90%, and some of them have disappeared. The blockchain may still exist, but the project is dead, and anybody trading it is really just trying to find something from previous cycles. And so this chart has been around in the crypto space for about 3 years, 4 years now, and it's the path to altcoin season or alt season, and it shows you the money flow theory on how it works, where people buy Bitcoin as their reserve asset, and it's the first mover, and then Ethereum, and then larger caps, and then altcoins, the smallest caps, and they make the largest gains, but they're also the most speculative and the most risky, so they're slower to catch up on the speed. And so what happens when the market learns this is it becomes more hyper aware. And so if I go back, it becomes highly aware of this trade. And so it begins to preemptively try and get in on these altcoins rather than try to play it step by step and be lagging behind on the gains to be made. So this alt season will continue to flow from the risk off coin to the risk on coins. Now, here's where we're going to talk about the Federal Reserve and setting interest rates. We see that every time that there's been a massive bubble, the interest rates have begun to rise, and then they peak out, and then there's a crash, and then the Federal Reserve has to lower interest rates into the crash. And if they lower interest rates and they continue to do this, eventually we see that their cycle is hitting where there's nowhere to go because they've hit virtually zero. And so there's not much more incentive you're able to offer by lowering rates at this point, and increasing rates eventually causes a bubble to pop. Right now, the rates are effectively at zero, which means that the risk on trades are still going, but if they raise rates, they'll cause the bubble to again disrupt and pop. And if they don't raise rates and it still pops, there's nothing they can do to really incentivize more lending into the market. So we see that there's some volatility that is created by this continuously declining metric that is now causing more problems. And so when markets crash, and when rates are too high to support it, and when lending into the space disappears, liquidity sell-offs happen. And it did happen to Bitcoin, but it also happened to everything else. In March 2020, we saw a massive sell-off in everything. And items found kind of their floor. But ultimately, it will happen to everything when markets sell off, bonds get bought up, the DXY, the dollar rises in terms of purchasing power against other currencies. And everybody panics. But the recovery from there swings into assets that should be the next play. Now, if the Federal Reserve were to pump money in after a bubble pop in the tech stocks, there's the Cantillon effect that may come into play where it's got to go into monetary assets, and typically those are gold and silver. We saw here that it also included Bitcoin, and it's likely to repeat this cycle because even though Bitcoin is highly valued compared to its previous price, again, it is a small market cap, and in fact, it's approximately the same size as silver's market cap, which again implies that it can function as a speculative risk asset, but also a hedge against inflation, and it accounts for growth in other spaces. Silver is largely 50% industrial, gold is approximately around 10% industrial, Bitcoin has no industrial value, but it's linked to the crypto space. So they each give you a speculative aspect to an economy that does in fact exist and need a reserve asset. And so we look at the Federal Reserve's balance sheet and the returns on the S&P 500. And what we're going to start seeing, and what we keep seeing, is correlative responses to trends up and down in the Fed's balance sheet. And so at the top we have last week's closing of the Fed's presentation of the Fed's balance sheet, and the S&P 500 dropped. But then this past week we saw the balance sheet increase and the S&P 500 recovered. It seems as though we're seeing a constant correlation continue to rise. That is not a healthy sign of a good, strong market. That's not to say that investors are completely wrong in all of their assessments of the market, but that the pricing is extremely high and that asset purchases by the Federal Reserve are likely feeding into asset prices. And as admitted by the European Central Bank, quantitative easing is inflating asset prices. So we do know that the balance sheet of the Federal Reserve has a real effect into asset prices. This chart by Alhambra, I hope I'm saying that right, shows inflation statistics, CPI statistics, and the 5-year, 10-year, and 3-month equivalent Treasury bill. And what I'm going to focus on is in World War II, from 1943 to just up to about 1947, and yield cap continued into 1950s, the bond market identified that there were restrictions and limitations in supplies following the closure of the war, and this point was brought up by Lynn Alden, that the yield curve, the yield effectively lowered anyways, even though there was already a yield cap, because people actually wanted bonds because there was actually a limitation on goods and services that you could invest in and buy. Now, once that yield cap was removed, the CPI rose, and so did the bond rates. And what we saw was then inflation begin to actually kick up. So prior to around 1957, it wasn't real monetary inflation, but it was the increase in prices of goods due to a lack of supplies, like we are kind of seeing right now. However, I'm going to again show you that it's not entirely just because of supply chain issues. After 1957, as we went into 1955 in the Korean War, we started some serious monetary inflation, and that did actually increase inflation, and so we actually saw real results into the bond market of the inflation expectations going up. And so, like I said, I'm showing just this past year's, 2 years, consumer price index increasing. We've had a massive swing up over the past several months over month once we started coming out of COVID, and a lot of people think that it's because of supply chain issues or recovery. But by the Bureau of Labor Statistics' own data, the chart below shows that now this ends in the end of July, but the chart below shows that most of the inflation is in energy and non-reopening components, contrary to the argument that it's mostly things that have to do with reopening. It may have been true earlier on in the year, but as the time has progressed, it is actually not. In fact, there's been disinflation for periods of time in reopening components. We are seeing monetary inflation have a real effect on goods and services, and I bet you if I can get it at more advanced charts soon, we will continue to see that this evidence is increasing, that it is mostly energy and non-reopening components. Now, currently, the long end of the yield curve, that's the 30-year over the 10-year, is predicting that there's going to be a rate hike. And at this point in time, based off of when the FOMC meeting is, the long end of the bond yield is proving that the market thinks that they're going to rate hike or cut QE. They're going to do something to cause disinflation or a temporary deflation in asset prices. And so people are actually buying bonds right now to their own detriment because they're expecting even worse detriment, and it's better to hold a bond than to hold a dollar because at least you're getting something out of it. You're getting some type of yield. But again, the inflation is high. It's around 6.2% right now, and the Bureau of Labor Statistics is pointing to that we should have 6.8% by December 15th. And what I want to show here is that if the asset purchases are holding down bond prices, we are still seeing a dip occur where it's understandable that back in May 2020 all the way into 2021, the bond yield was low because people were fearful of the market. But as the recovery came in December, there were vaccines announced. it's clear that the market started to accept that things were possibly going to get better. But then supply chain issues and inflation data started coming out showing that things weren't going to be great. And so we saw again another dip. Then we saw some sell-off in bonds as inflation data began to rise again. Now we're hearing news of tapering in asset purchases, and that's going to again cause fear that the market's going to dip. So this is essentially the market just predicting, in addition to the limitations provided by what effectively is yield curve control through asset purchases. And then I have the 3-year bond just to show a shorter term view that it's held pretty low for about a year and a half, but it's begun to rise. So it's already showing that the expectation is that you have to get more for your bonds. And so here is an overlay of gold and the S&P 500 over the blue line, which is the US 10-year yield. And what I've done is place that on top of the chart for the CPI in that period of time. We saw that 2008, the global financial crisis hit, and stocks began to sell off, and the bond yield began to go down because people were purchasing bonds. But inflation was rising that entire time, so people would rather hold bonds than stocks because the stocks are going to fall. And so even though there was inflation, they were losing value in their currency, they still would rather hold some bonds because of the risk that other things provide and the speculation on things like precious metals. But gold went from a $5 trillion to a $10 trillion market cap over that time period. It doubled in value. And at this time, miners were increasing output and governments were selling gold so to be able to fund activities. So, and to compensate for their value loss. And so what I would argue here is that the volume of buying was just so great that it still caused gold to go up. So we can see that even in inflation, the Cantillon effect begins to come into play. Now, even though the bottom of the market was around 2009, we're still going to see, while it's printing a recovery, that the market's still fearful and it's going to pile into precious metals when they anticipate both inflation, because quantitative easing was first introduced here, and they didn't have faith that the stock market was going to continue to go. And markets tend to react a little too late or a little too soon in multiple different ways. They over-speculate and under-speculate in every single opportunity, and so there's always overvaluation and undervaluation of every asset. And so here I have Bitcoin, and I'm just showing you the difference in the volume. And you can see that from 2016 to 2017, the volume began to increase steadily with a couple of spikes as prices jumped. But ultimately, the volume just increased into the peak. So traders got exuberant and excited. Well, here in 2020, we see that the volume was really high in the capitulation of the March 2020 lows. And then as you go into 2021, it begins to just continuously decline. And so why is price going up if volume is declining? And I'd argue that it's actually a supply limitation, because there is really just going down to your base investors, because people are interested in going risk on to these altcoins. And the volume is declining, but people are still purchasing it as a protective asset. And so if you're not purchasing Bitcoin as a reserve asset, your purchases of altcoins are also feeding those who are willing to go out on the risk curve, because then they'll take those profits back to Bitcoin. This is also from Game of Trades, and it shows bullish divergence in the illiquid supply. And the illiquid supply of Bitcoin are coins or wallets that hold Bitcoin for approximately a year or more. It shows that these coins are less likely to be sold in high volatility of moves. And so the illiquid supply has reached new all-time highs at 14,400,000, or approximately 76% of Bitcoin's price, or Bitcoin's total market cap. So what that implies to me is that people are buying this regardless of whether or not the price is going up or down. So it is diverging from any correlation to the price at this point, because people are buying as it dips. So this is an asset in accumulation, not in a distribution. This is the whale supply from Glassnodes, published by Will Clemente, and he just shows that the total whale supply of Bitcoin has continued to increase throughout this cycle, meaning that they're buying. And if you think the mantra, if they're buying, I'm buying, when central banks are buying gold, whales hold over 1,000 Bitcoin each. And so if they're increasing their total holdings, it tells you that they are buying massive amounts and they're continuing to buy massive amounts. But I will point out this benevolent whale theory that I kind of have, and it's whales are looking to defend themselves, but at the same time they need to take profits because that they can't spend their Bitcoin into the real economy just yet, and they want to be able to possibly increase their total cash holdings throughout in order to move them into other assets and re-diversify slightly. So if you have 1,000 Bitcoin, you're very defensive of that Bitcoin, but you are going to capitulate and sell. And so the number of whales total has increased in Bitcoin as the price began to move up because wealthy people began buying it again. But the price has gone up so much that there are not as many whales as there were before. And we're likely to see a decline in the number of 1,000 Bitcoin whales because the price will continue to rise and there will be less and less people who can ever afford 1,000 Bitcoin. This from Altcoin Daily today showed that the Bitcoin balance on exchanges is actually at an all-time low, or a 3-year low, meaning that Bitcoin continues to leave exchanges and go into storage or go into lending so that people can actually use their Bitcoin. So they're either swapping it somewhere else or they are hoarding it. And this dragon hoard of Bitcoin continues to increase, meaning that there are less and less coins available every single day. Bitcoin revived supply is coins that hadn't moved for 5 years. That is a long time to hold Bitcoin. That means these people held Bitcoin all the way back at the top of 2020. And we got up to $69,000 and they sold and then they stopped selling. So the price went down and they didn't sell. That's another bullish divergence, that the price is going down and they're still not selling. There was some selling as the price goes up. You want to sell into rises, and we can see that they sell into rises, the people who hold Bitcoin for long periods of time. But once it started going down, they just stopped selling. And so we're seeing a reduction of supply and long-term holders becoming more and more vigilant to retain their coins because they've learned that selling their coins leads to less earnings, less value. This is the SOPR. It's the spent output profit ratio, and this has a variable point or a central point of 1, and as long as it's over 1, the majority of Bitcoin holders are in profit. If it's under 1, the majority of Bitcoin holders are in loss, and right now Bitcoin holders are still in profit. Now it can dip below that line and jump back up, but as it goes below that line, it tends to lead into a bear market as people try to sell into a loss because the highly liquid entities are trying to just get out. We haven't seen that point yet. That doesn't mean it can't come, but thanks Game of Trades again for providing these fundamental charts. Now this is from Willy Woo. This is the stock to flow model, and it has to do with the 4-year cycle and the reduction of total flow of supply from miners into the market. And his general theory was that we would continue to see climbs within these zones because of the stock to flow. But I'm going to argue that adoption is not going to lend us into this. And Willy Woo even argues that eventually one day Bitcoin is going to break correlations with its own trends, and it will just monotonically begin rising in a, I think it was called a random walk to $1 million. And you're just going to continue to see the adoption cycle go through. And we've gone through 3 major cycles, 4 if you're counting today's, but the stock to flow has generally played out. We're a little low on the stock to flow for our current time frame right now, but overall it has been playing out. This is the Bitcoin stock to flow cross asset spiral by the Rational Root. And it shows that we've gotten less volatile as we've worked our way to spiral out towards the higher and higher market cap. And so we're going to slowly reach towards the $10 trillion market cap as we spiral further and further out. And we can see that the juts have gotten less violent, but the spiral may have narrowed some, but overall it just continues to work its way out as adoption continues. And so when it comes to innovation, we see this S-curve of market adoption or market share, and then the slow adoption rates at which the majority jump in. And right now, Bitcoin is still at sub 15% of Americans who have held or transacted in it. And it's only approximately 3% of the world who has transacted in Bitcoin. I think it's 3% of the world who's transacted in cryptocurrencies at all. Now that's up 100%, and we've gone up about 100% per year. It's up 100% in 2021 from 1.5% of the world. So we are slowly but assuredly moving into advanced adoption. But if we break that 15% line, does that mean that we start jumping into the early majority and the S-curve really starts kicking up? Here we have from Jordan Lindsay his application of Amazon stock price as a cycle over Bitcoin's last 2 cycles to show that there are cycle events that have kind of had correlative relationships to how markets go through adoption phases. And so you could see in Amazon that it had its own 4-year cycle that didn't have to do with stock to flow. It had more to do with the business cycle. And so as the business cycle went into adoption, we had major events like the 2008 financial crisis led to a dollar liquidity crisis. And we see that overall, the adoption has continued anyways. And to show that, here is Amazon, Microsoft, Apple, and Netflix going through waves of adoption. At first, they go through cycle waves and phases, manias, speculative hype. People tell them that it's going to go down, that it's not going to make it, that it's not going to be as successful, or that it's going to be profitable long term, but you'll see a diminishing return in the asset because it can only take up a certain amount of market space. But all of these assets have proven that they're here to stay. Now, that's not to say that some of these can't be replaced down the road as a technology company, as they get bid out by other competitors. But one thing about being a reserve asset is that once you reach that level of adoption, there's no reason to replace it. It's now a reserve asset. Everything else can function as technology or stock within that, much like if gold were to be adopted, it wouldn't displace stocks. It would just be the reserve asset that everyone relies on. So we see that they go through these cycle phases, and then eventually they just start taking off. They just make one big transformative move, and everyone accepts these are here to stay. And I would argue that Bitcoin has hit the point, cryptocurrencies overall have hit the point where people say, hey, these are here to stay. What are we going to do about it? Bitcoin is one of those ones where there's no reason to argue that it's not going to stick around unless you just truly believe that it needs to be a technology, but that its sovereignty as individual money, self-custodied money, is its own defense. And so if we were to look at gold, we can see that it's had the same kind of concept of cycles. But what has gold's weakness generally been is that it's not a technology, it is truly just a commodity. It wasn't able to compete with the technology of the dollar being paper. So since you could do fractional reserve lending, it was advantageous to banks and it was advantageous to stock markets to allow that type of leverage and opportunity. And because you could settle through ledgers in the bank, then there was no reason to want to just go back to a gold standard because the government was able to incentivize a small minority of highly wealthy people to utilize their technology. Now, Bitcoin puts you in a position where you can go back to both using custody banks, but at the same time, it is direct custody and it can be instant global settlement, meaning that there's really no reason to go away from using this as a reserve asset, unlike there was with gold. And so the only way I could see that gold would go through these cycles of adoption and then go monotonously up would be if it were to go back to a gold standard, because then it would just spike right up to whatever the valuation is, and then it would hold there for the dollar ratio. It would hold there, and then technology would be applied to have it as a central bank digital currency. But we're faced with the ever underlying problem that even Henry Ford brought up, is that essentially it's the goldsmith problem, that governments can print money even with a gold standard because they don't have to constantly prove to you how much gold is in the vault. And so even with auditing, you can still forge or lie about what's in there. So it's not custody of the true asset. It doesn't work. And since you can't apply that, it's not to say that it can't apply some confidence, but eventually you're trusting a third entity to do it as opposed to custodying the asset directly. And so this argument has stood for a long period of time, and we can see that people like Elon Musk and Michael Saylor, who have been orange-pilled by many other idealists like Safety Moose, who argue that economists who argue that sound money is a better and safer money for an economy simply because it would remove the government's ability to act without permission from the populace. So overall, I think that there is a clear sign that Bitcoin is going to continue to garnish adoption, and that its adoption cycles are going to shift or break all correlations, as people say, because it is going to move into being a defensive asset. And the best test for it is going to be this possible next market correction and high bond yield environment, because it will go into high inflation and high bond yield environment. That may be the period where people really kick off adoption, both because of not just it's better, but because of necessity, because of what has been placed upon them by their current governments. And it's not just a US focused picture, right? It is a macro environment picture. And so this is my total thesis on how Bitcoin transforms from being a reserve asset in crypto to becoming a global reserve asset. I hope that made sense. I would love to hear comments and arguments otherwise. Thank you for watching Be Great Economics. I hope to see you next time.